Let's get down to business. Taking a look at Wall Street, Dow Industrials up 78 at 12,837. S&P 500 up 9 at 1,352. NASDAQ Composite gained 25 at 2,935. Yield on the 10-year note up 3 basis points at 1.97%. Oil back up again, gaining $1.46 at 106.16. And the precious metals moved higher as well. We'll get you an update on that in just a few moments. So, yesterday, the Dow Industrials dropped a couple hundred points. That was all it took. Today, the talk is about more free money from the Fed. The Murdoch Street Journal reporting the Fed is considering a new type of bond buying program. The Fed would print new money to buy long-term mortgage or treasury bonds, but effectively tie up that money by borrowing it back for short periods at low rates. I'm sure we're going to hear more details on this in the days and weeks ahead, but this goes in line with the idea that the Fed will try to juice the housing market in an election year. The initial guess is that this move might lower long-term rates and mortgage rates. This quantitative easing, in the article today, calls it sterilized quantitative easing, would use reverse repurchase agreements to keep the money from flowing to bank reserves. The thinking there is that it would not be a big boost of inflation. Now, the Fed has an existing program in place to lower long-term interest rates. Since September, the Fed has been replacing short-term securities on its balance sheet with longer-term securities, a program that's been called Operation Twist. This $400 billion program ends in mid-June. So this is no surprise. We've been telling you that the Fed would have some form of QE3, and it would probably concentrate on the housing market. This is a little strange, though. According to the article, the Fed thinks they can print money and then inject the money into the economy and then pull the money out, and there won't be inflation, and the dollar will get stronger. Okay. So maybe what's going on is the Fed might be trying to jawbone the markets with a news leak to the Journal. Who knows? The ongoing problem for the Fed is that there is no exit strategy from some sort of quantitative easing. And the reaction of the markets over the past couple of days just confirms that the markets will demand more and more and more free money from the Fed. They're hooked. Let's take a look at the economic news of the day. ADP, the payroll processing firm, reports private sector payrolls increased 216,000 in February, led by service providing sector and small businesses. Over the last 3 months, gains have averaged about 223,000 per month, compared with the monthly average of 156,000 for last year. Now, we'll get the government's monthly jobs report Friday. The January report, remember, showed unemployment at 8.3%. So the thinking is now that we'll probably see around 225,000 jobs added for the month of February, and the unemployment rate probably staying right around 8.3%. No big change. And yes, I know the jobs report is bogus and numbers are very imperfect, but these are the numbers we have. And the numbers, quite frankly, are getting better, even if it doesn't reflect the real severity of the unemployment and marginally employed people who are out there. Meanwhile, Labor Department report businesses were a little bit more productive in the fourth quarter than previously believed. Productivity was revised up to 0.9% from 0.7%. However, for all of 2011, productivity rose at a 0.4% annual rate. That's the smallest increase in productivity since 1995. So we need to dig a little deeper here. Hourly compensation adjusted for inflation, was up 2.8% in the fourth quarter. That was much higher than the initial reading of 1.9%. It was a big increase. It was the fastest increase in 9 months. But, and this is a big but, the benefit to workers was wiped out by inflation last year. Adjusted hourly compensation, adjusted for inflation, actually fell 0.7% last year. That's the biggest drop since 1989. So let's see if we can kind of figure this out. Stuff costs more, so people have to work more, or they need to get paid more for their hours worked. This kind of sounds like the roundabout definition of inflation, but we know there is no inflation. Oh, look, a shiny fish. Yeah, let's distract ourselves for just a moment. I mean, what inflation? Bernanke thinks he can sterilize quantitative easing, but he also told us there was no risk of wage pull inflation because of excess capacity in the labor markets. So the only thing I can figure is the Fed has been juicing the economy. Yeah, that's about right. Meanwhile, the Federal Reserve reports consumers increased their debt in January by a seasonally adjusted $17.8 billion. So debt went up in January by almost $18 billion. Over the 3 most recently reported months, total consumer debt has gained an average of $18 billion, compared with an average monthly gain of about $5 billion from October 2010 until October 2011. So it looks like we're adding a lot of debt all of a sudden. And credit has been rising for 5 straight months and 15 out of the last 16 months. So this would be an indication that consumers are finally really loosening their grasp on their purse strings, going out, shopping, willing to take on more debt because they feel more confident about their employment outlook. And you might think all this money circulating through the economy would have inflationary implications. But again, we have to dig a little deeper. The consumer is still deleveraging. Credit card debt actually declined by $2.9 billion compared to December. Consumers put a lid on the purse following a weak holiday shopping season. The increase in debt came from non-revolving debt, specifically student loan debt, increased by $20.7 billion. January was the start of a new semester. People are trying to get the training and education they need to move forward in a changing labor market. And the average household is still deleveraging. Once upon a time, higher education was not so expensive. Now it's turned into a profit mill for subprime lenders. Yeah, you know what happens there. Bubbles. The process of amending the U.S. Constitution to reduce the influence of money in politics is long and difficult, and that process was part of Super Tuesday in Vermont. 53 towns in Vermont have voted to push Congress to amend the U.S. Constitution to make clear that corporations are not people. They adopted a non-binding resolution on town meeting day asking the Supreme Court's Citizens United decision be overturned. That's the 2010 ruling that recognized the rights of corporations to participate in campaigns. They're still counting some of the results from Vermont, but it appears to be unanimous condemnation of corporate personhood. Meanwhile, we keep our eyes on the goings-on in Greece. Tomorrow is the deadline for determining whether there will be an orderly or disorderly default. It really boils down to how many private investors go along with the deal, and whether the ISDA can convincingly smile and convince people that the default is not a credit event that would trigger payouts on credit default swaps. Look, a shiny fish. Yeah, they're going to try and distract us a little bit. So anyway, with a CDS against a Greek bond, anyone with a CDS against a Greek bond has every reason not to participate in this orderly default. The idea is that ISDA can't call it a default without completely discrediting credit default swaps as a product, even though that's what they're trying to do. This could get a little wild. Everybody knows that credit default swaps are a huge source of interconnectedness and systemic fragility. The CDS is fake insurance, and it's designed to collect premiums but never pay out claims. And everybody knows that if they are ever forced to pay out claims, the whole thing goes boom. Either have meaningful CDS payouts on Greek bonds or having none, which discredits CDS and possibly destroys the multi-trillion-dollar derivatives market. Likely to have some unexpected but significant outcomes. So pick your poison. I guess that's what it ultimately boils down to. Tomorrow's the deadline, though, and we'll find out whether it's an orderly or disorderly default in Greece. Either way, though, it should be interesting. And either way, we'll keep you updated right here on Money Radio. Thank you for joining us today for the review, Financial Review. I'm Sinclair No.